We are live, so we can start.
Very good evening, the respected speaker of the day, CA Subhashini Ganapathy, and my dear participants for this wonderful program. So today we have a wonderful speaker who is an expert on GST and other indirect tax laws, and a regular contributor to our SARC in many events and programs. A very eminent personality. Here we have CA Subhashini Ganapathy. Subhashini Ganapathy is the founder partner of Subhashini and Associates LLP. She is a specialist in direct, indirect, and international taxation. Also a qualified forensic auditor. Addressed the CAs in many forums in international taxation, tax-related topics, and also motivational speaker to students community. On GST, she is accredited faculty by Institute of Chartered Accountants of India, Ministry of Skill Development, has been a part of initiatives in GST awareness by Tamil Nadu government and ICT Academy. Has trained the department officials in many programs as a faculty member in DTRTI, training the income tax officers and the officials of the income tax department. Also trained the GST officers on various topics. She's a forensic, has a wide experience in forensic audit. Have led the team in unearthing a fraud of 30 crores in an institution where court proceedings are on. Was a co-opted member of the research committee of the SARC of ICA. Was a co-opted member of the SICASA of ICA. Committee member of Society of Auditors, Mylapore. She's a regular guest lecturer in many of the colleges in contemporary topics. She has started an initiative with the support of a YouTube channel, RedPix 24/7, educating the general public, creating an awareness on the basics of the Income Tax Act, and now GST for the common man, the procedures, the preliminary do's and don'ts. The viewership has crossed more than 5 lakhs. Addressed more than 15,000 students as part of the career counseling program of SARC of ICA and Tamil Nadu government. Her extra curriculums would include a best outgoing student, both in school and college, national player in Kho, state level athlete, lyricist for a devotional album sung by Mahanadi Shobana and a briefing by Solvendar Sugi Sivam. It's a great honor to have a wonderful speaker here with us, among us, CA Subhashini Ganapathy. Over to you, ma'am. Thank you for joining us. It's a great honor for us. Thank you very much.
Thank you so much, sir, for the detailed, wonderful introduction and for the wonderful opportunity of addressing the learned gathering today. Very good evening, ladies and gentlemen. It gives me great honor to talk on this topic, this charitable organizations. So this was once a kind of topic which was completely ignored, where once the registration is on, then the exemption is on. That is the perception, like even today, many of the trusts carry. So we have an 12A or 23 registration, or we have a registration as a charitable entity with the income tax. Or even if we register ourselves as a trust, then we are totally exempt under the Income Tax Act, no matter what, no taxes paid, no questions asked. So all these things are turned to be a myth today. It was always so. So we had regulations, and charitable organizations and the income tax exemption was never a free meal. So nothing comes for free. The very objective of charitable organization, right from the 1880s, the pre-independence era, even during the British times, the very objective of the trust was to ensure that they are an extended arm of the government. So the government per se is into the welfare of the public, giving them education, relief of poor, so many other objectives, which is truly for the welfare of the public at large, where the government does not really have the bandwidth and the power to actually cater to all the entire crowd, the entire population of the country, or anywhere, any part of the world. That is where they actually co-opt the trust, the charitable organizations, to perform as an extended arm of the government. So this tax exemption certainly is not for free. Suddenly, why did this wake up come in? In the recent years, there are lots and lots of amendments around this charitable organizations. So today I have actually planned my presentation. Actually, like I don't have a PPT, it is only the kind of lecture which I'm planned. But the schema of my lecture today will be on the why this changes. So these changes, any regulation comes only after a violation. So the why aspects of the changes, the what aspects of the changes at the second limb. So what are the other conditions or the amendments or the notable points for us as chartered accountants and for the trustees as a whole, as a trust is required to maintain that status as a charitable organization will be the second limb. Third is the maintenance of books of accounts and the compliances under all other laws. So what does it mean? And as auditors, what are the precautions we should take when we are signing an audit report? And the fourth limb will be the explanation of charity, because we hardly get into the details and nitty-gritties of the charitable organization's mother document, be it a memorandum of association or articles of association, or be it a bylaw of a society, be it a trust deed of a trust. There are so many nitty-gritties into which the deed or the mother document has to be looked into. So we will discuss those things, the deviations and the resulting implications through case laws. And the last limb of my presentation today will be on the FCRA amendments. So the 5 limbs will be why, what, and the actual impact of the changes, the charitable specs, actually the legal aspects of the charitable organizations which has to be looked into, and the relevant case laws, and the FCRA amendments. So this is how we are going to start our presentation today. So why regulation, basically? So today, thanks to the digital era, there are so many changes or so many information which is available with the government. So when we look at the digital information which is available, of course, we have all the financials, data, etc. as for the entity which is registered with the Ministry of Corporate Affairs. Be it erstwhile Section 25 or current Section 8, we have the financials and all the resolutions, etc. Everything filed with the Ministry of Corporate Affairs. Take the trusts. The trusts are governed by the Indian Trust Act. And of course, like certain states like Mumbai and all, they have their own local trust act, which is governed by a charitable commissioner. And Tamil Nadu, of course, we had a bill which was presented, which was actually drawn or it lost its status as a bill itself. So it did not turn into an act, where they were like draconian or probably lot regulatory provisions related to the assets which were maintained by the trust, and the auditor was responsible for preparing the income and expenditure account and presenting it to them. And the penal provisions were like very huge. The trustees' KYCs were stringent. There were so many other aspects which came into the Tamil Nadu regulation bill, and it is not in work anymore. So given all these data, and we take societies today is digital. Maybe a couple of years, today we've gone digital in Tamil Nadu. Similarly, like there are other states which are not still digital. So for a center for the income tax department or for the ministry which is taking care of the welfare to do a study on what is actually happening around this the charity aspect was not very easy. So they were like, when they analyze the data of a society which is registered, there were flaws in terms of data entry, because they had to pick in the manual data, translate it, enter it digitally, and then analyze. And the only document which was available was the income tax return. So for us as charitable organizations, we can be of any form. So either a Section 8 company or a society or a trust or a cooperative society or any other government institution. So we can be in any form where we can be still called as charitable organization. So the section worded as like charitable institution. So institution can be in any form. The criteria, the main objective is the objectives under Section 215, which is being followed, which has to satisfy any of those criteria under Section 215. So given this fact, the only umbrella which captures all the charitable organization registered under whatever act, be it, is the Income Tax Act of 1961. So whether it is a company or a society or a trust or a cooperative society, whatever, the very objective of creating a charitable organization is to get the exemption, the income tax exemption, or to put it other way around, the income tax exemption is the kind of key for someone to do charity, because if someone has to collect money, take the pains, do all the philanthropic activities, and finally, end of the day, if they have to pay tax, then people would really think twice. So that's applicable even today. In case if they violate any of the provisions, then they are liable to tax. That's a different story. At least if I am compliant, the exemption is available to me. That is actually the key for registering or complying as charitable organization. Having said this, the only place where the data was available for the government to actually pick in the data and analyze to understand the actual ground reality of what a charitable organization does on ground was the income tax returns. So this income tax returns, when the government actually analyzed, there were so much of mismatch of information between the income which was reported, where the financial year 13-14, it was like 3.1%, which actually grew to 5% of the people who actually filed their returns. And there were a lot of information to the government on the black money laundering through trusts. So while the government on one end is trying to curb the black money, the money laundering activity through demonetization, through anti-money laundering or Binami transaction, etc., actually became so vulnerable, a good medium for them to do money laundering activity. For example, somebody gives a donation to a trust, say 1 crore of rupees. The trust buys a beautiful BMW of the latest series, and the BMW is used by the trustee. So these kind of activities, or the trust buys a property and the property is being used by a related person. So all these things were happening. Of course, like you might ask me that there were restrictions under Section 13 earlier itself. So what are the new amendments or things brought in? There were restrictions, there were violations. The gap of this restrictions and the violations is now being filled by the changed regulations. So where do we see whether there is a violation? Though like everybody is honest and everybody wants to do voluntary compliance, more so the trust. The Indian government believes in voluntary compliance, and the trust also is allowed to do voluntary compliance in terms of their compliance, etc. So the Organization for Economic Cooperation and Development, the OECD, when they did a study on the charitable organization, they also discovered that many of the nations where the charitable activities is given importance, the money laundering to the charitable activities are high based on the statistics research, whatever they did. And basically, like the mantra they give for the developing nations are make compliance easy and make non-compliance very, very difficult. So based on the amendments of the charitable organizations, whatever came in, there were powers to the commissioner to cancel the registration for non-compliance under any other law. We'll come to it a little later. So this compliance, the essence of compliance can be brought in only by strict regulations. So this data, which was actually analyzed by the government, were like the charitable trust returns in 2014 were 69,723. Others were like 1 lakh. And in 15, it was 87. It was increasing and the others were decreasing. And the gap of the monies which were brought in terms of the new investment, the accumulation and the actual ground reality of the impact study, which is mandatory under the CSR today, all these were completely kind of thorough mismatch. So the government could not tie the exemption, the benefit which the government is giving, the tax which is foregone by the government, to ensure that these activities are happening on ground, to ensure the benefit being seen by the government, the development in terms of the areas of education or relief of poor or yoga or any kind of preservation of monuments or any other public utility is actually not seen on ground. And that is why all these amendments were brought in. So this amendments actually is not a wake up like in the last 3 financial year as it strictly appears. So the first ever amendment or the important amendment was brought in 1st October 2004, where the power was given to the commissioner to cancel the registration. And 10 years later, 1st October 2014, the added ground for cancellation was brought in. And Finance Bill 2019 proposes an amendment to subsection 1 of section 12AA to impose another condition that the commissioner should satisfy himself about the compliance of such requirements under any other law for the time being in force. So which means if the trust does not comply with any other law, then it is more probable that the trust may not enjoy the exemption under the Income Tax Act. Having said this, under the Act for academic purposes, practically, is it truly possible for the for a commissioner to be a master of all the laws and to ensure that the compliance is there with all the laws? There was a case law in Dr. Madan Lal at Charitable Trust, this is CIT. So this was the case law where the government, immediately after the Finance Bill 2019, there was a case law where the commissioner rejected, stating that it has to produce data for compliance under all other laws, only then it will give the approval under section 12AA. So then it was actually decided that this compliance under all other laws should be read in tandem with for the utilization or for advancement of the objects of the trust. So this compliance under all other laws cannot be blindly applied or cannot be blindly accepted, while on one hand, where the trust or the charitable organization is enjoying so much of benefit, it has to be 100% compliant. And today, as the government is going, the phase of the government where any non-compliance, the government has zero tolerance. And when it is a charitable organization where the government is foregoing so much of benefits, the government is giving so much of benefits for the donors, and the regulatory mandatory thing which is brought in through the CSR activities, there are so much which is happening around the charitable organization. And if there is non-compliance around this charitable organizations, there's obviously going to be zero tolerance. Having said that, this compliance with all other laws should be read in tandem with, in advancement of its utilities. So because when we look at all other laws, there could be umpty number of laws. If it's a school, there's so much of laws, and any organization for that matter, there's umpty number of laws, and compliance with all other laws, the checking of the compliance with all other laws is practically not possible. So the macro or the substance wise reading of this particular compliance with all other laws should be in where it is in advancement of the objects of the trust. So there was other amendments in terms of the special provision relating to tax on accreted income of certain trusts and institutions. So today both section 11 and section 10 and 23C is brought in tandem to it. And interest payable for non-payment of tax by the trust or in the institution when the trust or institution is deemed to be an SSA in default. So all these amendments in section 115 PDTE and TF is being brought in. So the recent changes in the last 2 years. So for us as a trust, when a trust is registered under section 11, section 12, all other income which is being received is exempt, provided either it is brought in as corpus, then it will not even come into the criteria of 85% application. If it is brought into the revenue kind of income, then 85% is applied and 15% is accumulated. And in case if there is a possibility that I'm not able to apply that 85% of my income this year, then I file a form with the commissioner to grant me permission so that I accumulate this excess portion for a period of 5 years. So this was the macro level provisions around the trust, and there should not be any expense or any benefit which is flowing to the trustees or relative of the trusts. So section 11, 12 and 13, sum and substance, these were the essence of the provisions. So today the amendments in the last 2 years are like corpus donations shall not be considered as application of income in case of charitable trust. Now, what is this corpus donation? So whenever a donation is received, it has to be given with the specific instruction that it is going to the corpus of the trust. But how do we know that this is being given to the corpus of the trust? Earlier, probably like in Tirupati, all of us would have noticed that the Undial will have a board that all the contributions to this is going to the corpus of the trust. So maybe in certain situations, we give a specific receipt that this is in the corpus of the trust. And there were situations where we decide at the end of the year and decide that this amount has to be moved into corpus. So today, it has to be properly decided at the time of receipt. So to qualify as corpus, the money has to be designatedly given specifically for the corpus. The amount should be spent only for the purpose, like in case if the corpus is for any specific purpose, it should be spent only for that specific purpose. It should be invested in any of the prescribed modes under section 11.5. So when these three conditions are fulfilled, then the corpus donation, probably like the treatment of corpus is fulfilled. Now, expending this money from the corpus. Let's say like we have collected corpus for maybe renovation of a temple or renovation of a school or renovation of any other meditation hall or whatever we are managing. So this corpus today, this year, I have actually spent the corpus and I have received income. So can I treat this expenditure of corpus which I have made to fulfill that 85% condition? The answer is no. So this application of corpus is a separate bucket altogether, just that like we don't bring it in the income and expenditure account. So it is directly coming into the balance sheet as corpus fund, designated as corpus fund if it is collected for any specific purpose. Otherwise, it will be the general corpus, and this corpus has to be accounted clearly as to from whom it is being received with the identification as prescribed under Rule 114. And it should be invested specifically under section 11.5. So these conditions are mandatory to give it the designation of a corpus fund. Modification in objects mentioned at the time of registration of the charitable firm. So today, the charitable institution actually has to give the main objects. Of course, the objectives of the trust, we will have anything and everything under the law. So for safety purposes, we will put everything, and we'll also say like any other objective for advancement of general public utility, so that the trust is complete, the deed is complete. Tomorrow, if they want to change objectives, all that can be done. So today, when we are doing the re-registration, re-application, it has to specify the main objectives. And there are ample number of case laws which we will discuss at the fourth limb of our presentation today. And filing of return of income has to be within the prescribed time limit. And receipt of money or property by any person for inadequate consideration or without consideration shall be taxable under section 56(2)(10). And restriction on cash donation under section 80G. So cash donations cannot be accepted by the trust. Now coming to the books of accounts. So this books of accounts is a topic by itself altogether. I will just finish off the other amendments, which where 1023C, this accumulation of 15% is brought in tandem with section 11, because section 11 said you can spend 85 and accumulate 15. So now 1023 is also brought in tandem with that. Similarly, section 13 also, because like it wanted to give the same status to all the charitable organizations. Now that is also being brought. Similarly, accreted income is also being brought consistently. Income tax returns also is being brought consistently wherever, in whichever section you are registered. And the question is applied versus spent. So we are all talking about this 85% application. So let's say like I've received 1,000 rupees. So I have to spend 850, the 85% of my income, and I am allowed to accumulate 150 rupees, the 15% of the income. So this 85%, in case if I am not able to accumulate, is it okay if I just book this expense and spend it the next year? Now there was a case law to say that there was a dividend or distribution to the donees. Dividend is not the right word. The distribution to the donees, for which a resolution was passed by the trust. And this resolution actually was implemented the next year. So this applied was spent in the case law earlier pre-amendment of the act. This was allowed. So they said like, okay, fine. Anyway, it is earmarked for that particular aspect. And it was shown duly under the liabilities. And finally, like it was disbursed in the next year. But this year, it is not possible. The financial year, this financial year, it was allowed only when it is actually spent and not booked. So applied means actual expenditure of the amount. And this actual expenditure is allowed even if it is a repayment of loan or otherwise, which we'll look at it in detail. Now coming to the books of accounts, which has to be maintained by the charitable organizations. So there's a question: when NGO receives funds from online platforms, who deduct their agreed? Okay, once again, I'll just take the questions. Excludes the annual receipts less than 5 crores, 12 AB obtained up to 20, whether 12 AB registration to be surrendered. Okay. Above the society runs bus for students where the separate books of accounts. Depreciation is not claimed. Repayment, okay. Manmohan sir, exclusive educational institutions. Now there is, when you went for re-registration, you had an option to choose between section 12AB or 1023C. So now that you have opted under 12AB, then you can actually proceed under 12AB. And this 12AB, whether to surrender this and take a new registration is absolutely the choice of the trust, depending on what their objectives are going to be and how their plan of action is going to be. So we have to do a detailed analysis of which section the trust has to go and then decide. Now that you've got the registration already, so the moment you surrender and get a re-registration, the date effective will be now. And what will happen to the intermittent period? You will be using the different sections, which again will create complications. So you will have to decide in detail, looking at the vision of the trust for the next 5 years before you take a decision on this. And the society runs bus for the students' benefit. So running the bus at nominal charges is perfectly okay. It need not be business. So if when it is an educational institution, running a bus is actually incidental to the object. If it is nominal charges which is being collected, and of course this is supported by many case laws which we will be discussing. So in case if the charges are nominal, this can be in alliance with the normal objectives of the trust. Depreciation is not claimed. Yes, depreciation, if the capital asset is treated as an application, depreciation should not be claimed. Though there are case laws otherwise also where depreciation should be claimed, and it is against the principle of the normal accounting law where we actually show the excess, a kind of illusionary excess of income over expenditure without claiming this depreciation. All these aspects are there, but anyway, today, given the scenario, it is better not to claim depreciation on an asset which is already treated as an application. Repayment of loan can be shown as application, not a problem. Tax audit limit of a trust, our institute guidance note says like if a trust is running business, then the tax audit limit will be as per the business. And for a trust per se to be audited, Form 10B, the 2.5 lakhs is the threshold. And registration, Sabu sir, we have an educational institution registered under 12A. We have not, okay, extension of no, we have not filed return due to non-filing of 12A. Okay, so here under the new regime, unfortunately, there is no specific provision for condonation of delay, unlike the earlier laws pre-amendment where the commissioner had powers to condone the delay. Having said that, there cannot be a provision without condonation of delay, because this is completely a new provision and which has brought in during the COVID time, and not that all the trusts or institutions will have equipped people to know the amendments, etc. to file this Form 10A. Agreed that you have not filed your income tax returns also, which was absolutely not possible. So practically in what stand probably like many of the other members would also have taken is they would have actually filed ITR 5 stating that this is like without exemption within the due date. stating a grievance that due to this approval delay, we are not able to file this return within the due date. And after this, apply for the exemption. And once this exemption is come, then you can do a revised return in ITR 7. But now that you have missed the timeline, it is better to file a condonation request. There are also issues about the delegation of powers, because in all these sections, the power to grant exemption, to revoke exemption, to cancel exemption, everything is with the Commissioner of Exemptions. But today, apparently, the Commissioner of Information Systems, the CPC, is doing the activities of approval, etc. So there is this cross delegation, the validity of that, the time, all that is still a question. But given this state, I mean, this time before the law settles down, would suggest that you apply for a formal condonation, also raise a grievance, and file this return as soon as possible, so that like you are at least late than non-compliant. And when you go in for regularization after 3 years, 5 years, depending on your registration, you can actually explain with the facts. And before you go into this, better look into the provisions of the conditions which were allowed for condonation, the genuine reasons. There are specific reasons in the pre-amendment law which will be which can be condoned by the commissioner. So genuine reason that you were not able to file due to so and so reasons, it's better to get an affidavit for that, and also file a condonation of delay, so that your exemption is still live, and you can regularize this when you go in for the renewal at the end of 3 years or 5 years as applicable to you. So there are questions here as well. Soumya, there is no PPT. I think you joined a little late. Yeah, thanks, Manoj. I think you have answered. Department of a Foreign Government Department of a Foreign Government wants to do charitable activities in India. Is FCRE the only mode? Since foreigners can't be on board at inception, there should be generally a track record. Is there some other option to fast track it? A government department of a foreign government. Okay, FCRA is the only way, sir. To my knowledge, I don't see any other ways that some foreign money can come in for charitable activities into India, given the amendments of this one bank account and the restrictions on the trustees, the reporting requirements, the penal provisions, administrative expenses, etc. To my knowledge, that is the only way. When NGOs receive funds from online platforms who deduct their agreed service charges from gross donation received. Okay. Is there any tedious implication? Okay. So this again is a question. Of course, I will take it up later. But this gross donation per se, like this, whatever has to be applied is only the net donation. There are case laws which I will be discussing where the amount which is deducted per se is not in your hands, and a deemed income cannot be applied. So when we are today talking about an amendment where applied versus spent, then any money which is not received in my hands cannot be spent as well. So this TDS, if applicable, has to be deducted, and whatever net donation which I am receiving on hand will be applicable for this application of 85%. Can trust charitable organizations in mutual funds without any restrictions? So there are specified investments which are available under section 11.5. I don't think mutual funds is covered. So anyway, we'll have to double check. As per 12AB, all applications pending before the order has been passed on the date on which those shall be deemed to be applications made under on that date. So Satyanarayana sir is talking about the pending applications as on 21 will be deemed to be as applied under the new regime, and it will be alerted. I think that is all like so. Everybody has got their registration. In case if you have not received, there are few cases where the pending applications is still not approved. So then people are confused whether they have to do a reapplication or wait. So the better course will be to actually wait and raise a grievance. Yes. So what is their status? So they have to be approved, sir. And those time, the April to June approvals, where the places where the financial year was mentioned in the certificate, and all other places the date is actually mentioned. So you should be getting it. There are few cases where the grievance is the only mechanism. Just keep raising repeated grievances and you will get the approval. The return of income, and obviously you will not lose any exemption because the act says that you have validly applied for that. So your pending application prior to this amendment is actually a valid application, and it is for them to approve it. In case if they have not approved it, you will not the gap of exemption not being given to your trust. Having below taxation subject to non, okay. So there is a return of income filed under ITRB, ITR 5 having below taxable income 2.5 lakhs. Yes, this is a thing. So you will have to file a rectification or a response stating that you have received this. But to do a revised return under ITR 7, if I'm sure like you have time to file the ITR 7 irrespective of the fact that the return is processed. So today the returns are being processed in few hours, few minutes. So we can still revise the return. So you can revise the return so that this demand is wiped away. Or you can send a response to the income tax department in detail, quoting your date of application for re-registration, date of receipt of the approval, and the income tax returns, why you chose ITR 5 instead of ITR 7. And in case this ITR 5 was filed with a nominal amount just to ensure that there is minimum tax liability, then it is non-disclosure. So in case this is non-disclosure of income which is actually there, unrecorded income of the trust will be viewed seriously. So if that is the case, you will have to at least request for allowing you to revise the returns duly under ITR 7. So voluntary disclosure, at least in the grievance mode or response mode, will tantamount to recording. So there will not be any concealment of fact leading to penalty or cancellation of registration tomorrow. The safe bet will be to send a response in detail. 1023, okay. 1023C applications pending will be treated separately, sir. So all the applications pending in whatever section you have applied, so will be approved, and they are acting in fast track mode. There are certain cases where the time limit is also barred, but the approval has still not come. Grievance is the only mechanism. Keep raising grievances. But in case if you have filed the renewal registration on time and also raise these grievances, then the gap will not be there, because even tomorrow, like if the government says that your certificate will be valid only from the date where they have given it, then for the intermittent period, you can even go on appeal, because your side, you have done the compliance and it is on their part that they have not given the approval. Okay, trust deed registered. Okay, nominal value, the signature of all trustees is sufficient. So this Trust Act, Madam Pavitra, so here trust deed registration, to my mind, it is mandatory, because the application actually calls for registered document. So if academically the answer would be, the answer is no. There is no mandatory provision that the trust deed has to be registered. There can be unregistered trust deed in case there is no immovable properties, etc. So wherever there is immovable properties, this trust deed has to be registered, and the single trustees, the author and the settler and the trustee being the same person, is also allowed under law academically. But practically, certain registrar office, same within the jurisdiction of Tamil Nadu, maybe in some places, some registrar office they allow, some registrar office they say like there should be minimum 2 people for a trust to ensure. So for academic purposes, if you want to actually fight and tell them, registration per se is not mandatory. Unregistered trust can be there, but I would strongly recommend you to register the trust. So the next question obviously will be like, the trust was started way back, maybe in 2020 or even prior to that. Can we do a registration now? You can still do a registration now, and it will be valid. Obviously, like we will be discussing case laws on rectification of the deeds or the defects, which is still valid retrospectively, though not mentioned explicitly. All those things are valid. So I would strongly recommend you get registered. Academic purpose, registration is not mandatory, and a single author trust and single settler and the trustee is also valid. Practically, that is not being done in Tamil Nadu at least. Revise. Yes, you can file the revised return for things. You can at least request for revised return in case if you have not disclosed the entire amount, because obviously when we are doing a ITR file for the sake of filing it, we may not have disclosed all of the things because you don't have the provision of corpus and the income being exempt and all that in ITR 5. So ITR 7, we have the luxury of putting the amount in corpus and ensuring that 85% application, etc. So when we are filing this ITRV, if you have filed it with the correct information, it's a different story. If you have filed this thing just for record purposes with some random number just to ensure compliance within the due date, then I would strongly recommend that you do something, raise a grievance or request with the anomaly which you have gone through to ensure that the revision is done, or at least a opportunity that your return is being taken on record. So I would suggest, like, even in the grievance itself, you can actually put that your actual trust income is so much, so that you have in some means communicated to the department, because any income which is not on record, if the assessing officer finds out that there is income which is not brought into record, which is enjoying exemption, then it has serious repercussions which we should not fall into. So somewhere put it on record and ensure that this is being done. Oh my God, questions after questions. Trust A is running a school and a temple, charitable and religious trust. Trust B is newly registered trust. School and temple from trust A is to be transferred to trust B. Title deeds of the buildings, properties, land, etc. from trust A to trust B. Transfer of properties per se, like, will be valid. This can happen, like, only check you have to do is this trust A should have this dissolution clause, that in case the trust A is not able to carry on the activities further, then it can transfer its properties to another trust having similar objects. So this can be done through a settlement deed, so you don't incur a lot of stamp paper. At least I'm talking about Tamil Nadu. So it is still allowed under Transfer of Property Act, which is a valid thing. But the only thing you have to check is the clause in the trust A. What does it talk about when the dissolution, or where there is a situation that it cannot continue the activities anymore. Surat, sir, for society having 12A has filed Form 10B ITR after the due date. Okay, for assessment year 2021 and assessment year ITR process with demand. Okay, so 10B, actually they have condoned the delay. There is a circular which has come in where the delay in 10B, which the delay of 10B is condoned. So nothing to worry about the demand for non-filing of 10B, the non-compliance. If it is only due to that, there's nothing to worry. You can just raise a grievance stating that there is a time limit or the condonation of delay, or you can just raise a request requesting them to condone the delay, that due to some genuine reasons you were not able to file it on time, etc., etc. Okay, so oh my God, these questions this side. The education. Okay. So, yes. So Suraj sir, yes, for all the institutions, all the charitable organizations, be it trust, society, companies act, return has to be filed within the due date to get the exemption. But what if scenario? What if the return could not be filed within the due date? The academic purposes says the registration Sorry, there was some connectivity issues from my end.
Hello, ma'am. Hello.
Hello.
Yes,
Selva,
ma'am.
is it audible?
Yes, audible, ma'am.
Okay. Okay, so I will do something. I'll just continue with my session and take the questions, the leftover at the end of the session. So thank you for the questions. In fact, you can keep posting your questions. Probably we can keep 15 minutes at the end, or 15 to
Yes,
20
ma'am.
minutes
Maybe
at the
we'll
end.
take up the questions at the end so that we can deliberate.
Yes, we'll do that. So coming to the books of accounts, which has to be maintained by a charitable organization. So until today, the books of accounts basically was not prescribed strictly, except for the companies under Section 8 or Section 25. See, all others had the liberty to just maintain their records, and all what we would do is just take the bank statement, ensure that the donations, the source is there, and if there is anonymous donation, split it. And if there is application or debit in the bank statement, then you consider this as an application and filter out for any personal expenditure which is being done, and compile the accounts and close it. And that's how we do the audit, which is not possible anymore. So the CBDT via notification dated 10th August 2022 has prescribed the books of accounts and other documents should be kept in written form or electronic form. So they are not strict about any fancy softwares that the trust has to invest in. Even if the trust is investing, that can be treated as application of income because this is required for administrative purposes. These books of accounts can be maintained in handwritten form or the electronic form. In case if the trust chooses to maintain these records in a place other than the registered office, then the trust has to communicate to the commissioner that it is maintaining the books of accounts in the respective office, wherever it is maintaining the books of accounts, similar to our provisions under GST and under Companies Act. So this books of accounts per se, like what are the books of accounts? So this books of accounts include your cash book, ledger, your journal, your copies of counterfoils or bills issued by the SSE. So when we are talking about this counterfoils or bills issued by the SSE, when we are collecting data for filing Form 10BD, so there we collect all the information, the name of the SSE, the address of the SSE, the PAN number or the equivalent identification number as prescribed under Rule 114, and the amount which is received, the mode of receipt of amount, whether it is cash, check or online transfer, and the amount to which it is going. Is it a normal donation, or is it is going to corpus, or is it going to any specific fund? So all these details we actually upload in Form 10BD, and we give the Form 10BE to them, basis which they can claim the exemption. For this financial year, actually we did that, and it was not auto-populated in the 26 years. Probably like 22-23, it will get auto-populated. So when we are issuing the bills or copies of counterfoils for donations, so unlike those days where we had a bill book where we wrote that donation received thanks, received with thanks from so and so, etc. So today all this counterfoils has to be maintained, and when you are maintaining this counterfoils, please ensure that this counterfoils, in case if this is a kind of donation which is being done in a massive scales, maybe by school students or college students, or as a project or whatever, where you distribute these books and you collect this information, make sure the receipt books contain the information which is required for you to file 10BD if your trust is registered or the institution is registered under Section 80G, so that they get the benefit from you filing this Form 10BD. In case if you are not able to collect all this information, it will be treated as anonymous donation. And if it is an anonymous donation for a non-religious entity, then you have the ceiling of 5% of your gross receipts or 1 lakh, whichever is higher. Only that amount you can consider as part of your normal donation. Anything more than that will be taxed at 30%. So make sure that this copies or bills of donations which we are giving contain all the information, which is a must mandatory thing. In fact, like as a good practice, this 10BD form can be made in an Excel format and circulated to all the trusts so that they collect this information, so that it's easy for us also to file the returns, because this is mandatory. Any number of 10BDs can be filed. and 10Bs can be downloaded. And original purchase or expense bills. So here, while the department on one side says you can claim exemption or the treatment of application of income is as per the actual expenditure. So booking this bill and paying it later will not work. You can still book this bill and pay it later, but this will not be treated as application within that 85%. So maybe like you have paid 85% and you still have expenses which are booked, not paid to the extent of 10% or 20%. This 20% which you pay in the next financial year will be treated as application only in the next financial year. But this bills, purchase bills, expense bills, etc., has to be maintained in original. So there may be situations where multiple projects are being done, and maybe the projects are in the remote areas where they use autos, or situations where the bills cannot be taken. Then we'll have to, depending on the trust, depending on the modus operandi, we will have to ensure the documentation in place to ensure that the expenditure is genuine. If the expenditure is not genuine and if the expenditure is material to the revenue of the trust, then there is every possibility that this can be brought into this non-compliance mode, and the very exemption of the trust could be withdrawn. So of course we can fight it later. All that is there, but it's a long drawn route, which obviously we will not prefer to take. And any other books in order to give a true and fair view of the state of affairs of the NGO. So what is this any other possibilities? So here you have the record of the project. So for the NGOs, if it could be like FCRA, there may be projects which they are giving as proposals to give donations. Even for CSR activities, when they give proposals, this proposal may undergo different modification. But like we will prepare all these projections or the project reports depending on from where we will get this donation. For a CSR, for a corporate which is having a CSR fund where the board has decided that this will be spent for educational purposes, then we have a trust which is filed CSR1 and we are eligible, having this educational track record for the last 3 years. We have our 12AB, we have our ATG, all that intact. Then obviously we will be preparing a proposal, a project to say that we are doing this project and we will be submitting it there. But maybe this will undergo a lot of iterations before it gets approved. So the final copy of the proposal of the project has to be maintained on record. This might sound like, of course, we will have a final copy kind of a thing, but when it is coming, when the assessment is taken, maybe like after long years, especially like when the prescribed books of accounts has to be maintained for 10 long years. So 10 long years from the previous year, which means for effective 11 years, we will have to maintain our books of accounts and records, starting from your journal, ledger, cash book, and original bills of expenses. Even if it's a credit card swipe, we will have to take photocopy and keep it, because this originals have to be maintained for 11 long years, and this will go away. So all these things, when we are looking at the original document, maybe after 5 years of starting a trust, then we may actually scout version after version. So this final document of a project and the execution. So there should be a project budget and the execution. And obviously for CSR activities, we will be giving our report, however like we have spent. So this information which we are giving in FCRA return, maybe for a company for executing the CSR, and the records maintained for the trust and the records maintained for income tax purposes, everything should go in tandem. So this books of accounts is becoming very, very critical, and every single expenditure, every single money which is received as corpus, every single money which is received as CSR has to be maintained with the detailed KYC as prescribed under section 114. And what is, I mean, rule 114, what is rule 114? Like if I'm an individual, then my passport, Aadhaar card, my voter's ID, my bank passbook, etc., for address proof and ID proof. There are like still a big list: my credit card, my post office savings bank account, my gas connection, and if I'm a minor, then the birth certificate or the school matriculation certificate, etc. If I am a foreign national, so if I am a foreign citizen as an individual, a company or a firm or other type of institutions, then my KYC will be, if I'm an individual, then of course my passport, OCI card, or my social security number, or any other tax identification number which I can have from the relevant country, which has to be apostille. So if it is coming under this apostille act of, like, I think it is 1961 or something. So if you have signed that apostille thing, if it is a country which is into that apostille condition, then it has to be apostille. If it is not, then it has to be routed through any nationalized bank in that country or through the embassy. So only this, if it is a company, then again, like similar incorporation certificate or the similar document for existence of that company in that country, and same condition applies for firms, etc. So for any entity, any person outside India, there should be a identification document. There should be an address proof document, which has to be apostille if apostilling is applicable, or it has to be signed by the embassy or through the nationalized bank of our country. So for example, if there is a State Bank of India in Singapore, and apostille, of course, is applicable in Singapore. In case if we assume it is not applicable, then it has to be attested by the State Bank of India in Singapore. So this KYC documents are very, very critical. Otherwise, there's a very fine thin line of slip that your proper donation received might slip into anonymous donation and might go into that tax tax bucket. And records related to the income, of course, like you have to have all the information related to Form 10BD. So the next question is, only when I'm claiming ATG, this Form 10BD is relevant. So what for the others? So even if you're not registered under Section ATG, so you're still claiming your exemption under Section 11, then all this information is mandatory, because your KYC of the receipt of money is mandatory. So though it is not specifically mentioned that you have to have all this information, but it is a good practice to have all the information, because as given in Rule 114. And records related to the application of income. So this application of income, of course, like now it is all in par. So all the charitable organizations are in par, whether it's 12AB or 1023C, etc. So this application of income, we need to have all the relevant documents related to this application of income, the original bills, and whether we have received proper quotations. There should not be any inflation. There should not be transactions with any related party. It should not get affected under Section 13. We have to have prudent, normal internal control procedures for this expenditure. It should be at arm's length, though transfer pricing, etc. is not applicable here. It should be at arm's length, because the substance of bringing in the books of accounts and records, and the substance of our audit as chartered accountants, is to ensure that the money which is being spent is actually going to the effect of the development of the country as a whole. So then sorry, I think there was some connectivity issues again. So pertaining to this accumulation of income, when we are filing this Form 10, the form is pretty simple, which says like I am accumulating my money pertaining to this previous year, this percentage of income for a period of 5 years. So next the question comes is, in case like every year, maybe like next consecutive 3 years, I'm not able to spend this 85%. Can I file this form every year so that it becomes a rolling? So this will be 5 years, next will be like 4 years. and all that, it can be possible because Form 10, the language of Form 10 only says this previous year. So amount received in this previous year where I'm not able to accumulate, basically because Income Tax Act is more related to the financial year and previous year, I'm sorry. So, and coming to this resolution of this purpose of accumulation. In practice, many people say like this is for the advancement of the objects of the trust. So if it is for the general advancement of the objects of the trust, probably the need for this specific Form 10 at all, like they don't arise at all. So the very essence or the requirement of this Form 10 is to communicate to the commissioner, is to show them that we have a specific purpose other than the general objects for which I am accumulating this money. So this specific objects, the object should be specific for which I am accumulating. I'm talking about the accumulation more than that 15%, which I am accumulating for the next 5 years. And this reason for accumulation should be kept on record. And the resolution, of course, like only the phase of resolution, like what we submit for the MCA, the extract of the minutes of meeting held on so and so. Our Form 10 also talks about result and only that crux. So there should be some discussion behind that. So it cannot be just like a last day affair where it says this Form 10 has to be filed within 6 months from the end of the financial year. And this investment of this money into Section 11.5 prescribed modes of investment also should happen within 6 months of the end of the financial year. So it should not happen on 30th September that I'm just filing this form without any back papers. Now that books and records are mandatory, there should be proper due deliberations which are going, and there should be proper plan of the trust for accumulating, and there should be a purpose for spending this, and specific object should be mentioned in Form 10 for accumulation of this, and there should be like continuous monitoring of this expenditure, basically because it can be accumulated for 5 years. Prior to this amendment, it was taxable in the 6th year. Today, it will be taxable in the 5th year itself. So if you are not able to spend in 5 years, you will be filing your returns in the assessment year subsequent to the previous year, which your 5-year expires. So it has to be offered for income tax in the 5th year and not in the 6th year, which has to be noted. And records related to application out of this accumulated income also has to be maintained in detail. Again, the purpose in aligning with the objects, the accumulation, the original bills, there should be like proper diligence in spending this expenditure, no Section 13 violation, etc. And record relating to this corpus donation, the entire KYC and why this is collected as corpus, we discussed in detail, and record of application out of corpus donation received during the previous year. So this record becomes very, very critical for you to prove tomorrow in assessment that given the amendment that this application from corpus cannot be construed as application for that 85% of the money which is being applied. So here the specific accumulation of the corpus, the specific receipt of the corpus, and the specific application of the corpus has to be maintained as a separate record, as a table where my opening corpus was this much, my corpus received for this purpose. In case if you are having different funds, it's better to maintain different funds. And in many situations, largely in government organizations, it so happens that the interchange of funds happen. In case there is interchange of funds where there is like money from this fund, maintenance funds is going to expansion fund or fixed assets fund, or some interchange happens, we will have to audit the underlying document, the noting sheet, and the approving authority for interchanged application of this corpus. So all that becomes critical today, given the application and the maintenance of books which is being prescribed. And record of corpus, accumulation of corpus spending, and the list of the 11.5 investments. So this section 11.5 is very important, because the moment it is losing the character of section 11.5, immediately it has to be offered for income. So it has to continue to be in the prescribed modes of investment. And in case if it is a contribution for any kind of long-term activity, maybe for maintenance of building, or maybe renovation of some temple, etc., then records relating to this, the collection and the related application has to be maintained, like records relating to loans or borrowings. So here, when there is application is more today in this ITR, it is so simple that it is not matching. There is some error which is being thrown. So it's so simple for us to say like there is some source, maybe a loan which is received. So when we are saying the loan is received by the trust, it has to happen only through the modus operandi given in the parent document, be it the articles or be it the bylaws or the trust deed. So the trust deed should provide, or the bylaws should provide, the document should actually provide the modus operandi and the authorizations for taking that loan by the trust. And the document, the underlying document, in case if there is an interest payable for this loan, then that document, it has to be duly approved as prescribed by the mother document, the parent document of that particular charitable organization. And that has to be kept on record. The receipt of loan should not go into pay any direct expenses, and a book entry will not help. So fighting this case and all that, again, is a longer route and possible, but let us not take that route. The safe bet would be to actually take that loan in this bank account, proper cash coming in, and then the expenditure is being made instead of diverting this loan directly to pay some expenditure tomorrow that might trigger suspicion. So, and similarly, this repayment of loans cannot happen to our whims and fancies. So in case if there is a proper schedule of repayment, then we have to stick to that schedule. Not that it is our choice. When there is a schedule which is available, I violate that schedule, especially when it is a loan taken from a nationalized bank or so. I don't pay my installments properly, and I just pay this whenever I have money types, and we will be violating the provisions where we will be like out of compliance. There may be a possibility that our exemption itself will be at stake. So records related to properties fixed asset register, probably like one of this document which was prescribed by the Tamil Nadu regulation bill, which is no more. But for any trust, the record of properties becomes very, very crucial. Basically, because this capital gains and this transfer of assets, investing this assets, usage of this assets by the related party, etc., can be arrived at or can be like looked at in detail whether there is any violation. So this record relating to the properties becomes very important. And this record of properties, there may be situations where the properties are in the name of the trustees and it is not transferred into the trust name, etc. It is important that the trust, the trust which actually holds the property, the trust which is disclosing the income from the property should hold the property. So all this document, the conveyance document, etc., should be in place, and the verification of original documents becomes crucial. And records of specified or related person. So we need to get a list of people who will fall under Section 13 and ensure the transactions with them. Now that we have proper ledgers, etc., assuming all the trusts will follow this in detail, it is better to take the transactions in detail if there is any with the related party. So this form, it can be in written form, electronic form, digital form, or printouts. And as I told you, like it has to be in the registered office. So sum and substance of records of maintenance of books, every single transaction. So whether it is a income which is received as donation or as corpus, proper documents, KYCs, amount which is coming in, details has to be maintained. As far as the accumulation, application of income, every single original bill has to be maintained. For accumulation, there should be underlying reasons and Form 10 duly filed within the timeline. And this resolution, underlying resolution be maintained. For the loans which are being received, it has to be in compliance with your parent document, be it your articles or be it your bylaws or be it your trust deed. And for the loans which are being received and repaid, it has to be in line with the provisions. So whatever financial transactions are happening in the trust, be it the impact study or CSR, the administrative expenses, FCRA projects, everything should talk one language. So the final document which is being placed has to be preserved for 10 years, either in the registered office or in a place which is communicated with the commissioner in full. So this is regarding the books of accounts. And as far as the audit is concerned, ICI expects disclosure in respect of the following: the method of depreciation, irrespective of the fact that you claim this depreciation as an application or otherwise. The suggested method would be not to claim depreciation on an asset which is already treated as an expense. Recognition of revenue, accounting for income and expenditure on research, foreign currency translation, valuation of inventory, valuation of investments, treatment of retirement benefits, valuation of fixed assets. If there is a government grant which is involved, then AS 12, the applicable standards. And in case all the auditing standards are applicable, and anything related to the insufficient documentation, absence of appointment letter, insufficient working papers, qualification in case of non-compliance in terms of any accounting standards, improperly drafted audit report, casual approach in preparation of financial statements, audit plan, checklist, engagement letter, management representation, and all other documents. So this audit, when we do for a charitable organization, it has to be done with more or double or triple vigilance as we do for a limited company, because it is more critical where the public money is involved and the government views it more seriously. And the very fact that the government has taken this segment of charitable organization very serious is so very evident, given the plethora of amendments which are coming in, and checks and balances which the government is trying to put everywhere to ensure that the philanthropy activities, the charitable activities, are in essence the charitable activities which is getting translated into the actual result of development of the nation. So practical issues in terms of this charitable activities, they will not have insufficient manpower. They will not have sufficient manpower to maintain all this. So when we are going to today, like, tell the charitable organization, the small trust, in fact, like when a trust is doing business, maybe like a pharmacy or a kind of bus which is being run for a consideration, all this, if it is considered as business, then your business revenue should not be more than 20% of your gross receipts. So all those conditions are there. So either it was like 10 lakhs, 25 lakhs, and all the small trusts were under that shelter. Today it is 20%. So even if your gross receipts is 3 lakhs, then your limit is 20% on that. So you have to maintain separate books of accounts and ensure that that books of accounts is as per the prescribed norms. And this is like separate, and this is not given as like application. And the probably the macro and the most important point which we have to check when the trust is running a business also, this is like the trust should not feed the business. The business can feed the trust. So that is actually the test, irrespective of the amendments, irrespective of the rules and laws which are being amended. As long as the business is feeding the trust, there should not be any issues in terms of that. But given the mindset of the charitable organizations, that they think that the moment they get this approval under section 12AB or 8EG, it means that they are like free from all regulations and all income which is received by them is exempt. That mindset change, this there should be a complete paradigm shift in the mindset change. Otherwise, it is going to be, it's not going to be easy in the forthcoming days. So if the trust has to invest in resources, invest in preparing the documents, invest in putting controls in place, invest in preparing a fixed asset register, investing in preparing a property document or properties register, all that has to be done, and it is high time. So it is not that we are talking about a scenario which will come next year or year after next. It has already started and we are late. So because this amendment came during the COVID time, there was extension and extension and extension. No wonder that an officer might take the stand as retrospective and ask for all the documents, because anyways, though it was only prescribed on 10th August 2022, any which ways a trust was supposed to be compliant under all other laws. So, and the honors to prove that this particular income was spent for charitable activities in line with the objectives, etc., lied on the trust. So now that it is spelled out, all this existed earlier as well. So there is no excuse that we can do it later and all that. It has to be done, and as chartered accountants, we should ensure that we are not succumb to any kind of pressure environment. They are earning very less income. They're really doing good activities. They may be doing real good activities, but unfortunately, today these real good activities and substances cannot be explained as emotions. So today it is the document world. Document is the only thing which is going to speak, especially given the faceless assessment era. So when they are asking for documents, it is only black and white. Either you have it or you don't have it. There cannot be any other explanations, or there cannot be situations where you can go back and prepare the documents. Now, given the entire list where we saw a total, detailed list of documents, books of records, which has to be prepared. For example, like somebody gives in a donation today, we miss asking all those information. So they are giving this donation thinking that you're not going to ask for any information. So tomorrow, when you have to file a record, you don't want this to be treated as an anonymous donation, and you are not a religious trust. You go and ask them for information, they are not going to give. So it is high time we are alert, looking at the shift, the paradigm shift which has occurred in the atmosphere, and adapting to it, educating our clients to maintain the books of accounts, probably like preparing a Excel which is linked to the bank statements, where every rupee in the bank statement, whether it is a debit or credit, is actually linked to your Excel sheet where you have all the details. So probably like an exhaustive list which is prepared for the income and for the expense, which is linked to the bank statement, will actually help you to check the documents, and you can also advise them to upload the receipts, etc., in that Excel sheet itself, because Excel sheet today also is a valid prescribed books of accounts. They do not actually insist on any software. So a normal Excel sheet with today, like we have a lot of options in the normal Excel to maintain this books of account. So the good idea would be to just share a template and ensure this is being done and monitoring this month on month, so that we don't get into surprises next year. And fortunately, ITR 7 is not one of those common ITRs, but we never know like what is in the way. So it's better to educate them in terms of maintenance of books of accounts, and being very, very strict and careful about our audit. So we'll just quickly discuss certain legal aspects and the amendments in FCRA, and chapter 645. I will start taking up the questions. No matter, even if it is extending a few moments, I don't mind extending and answering the question. So this charity under English law was like relief of poverty, advancement of education, advancement of religion, and any other purposes beneficial to the community, not falling under any of the preceding heads, which was like income from other sources kind of a thing. And having said this income from other sources, I would also like to add a point here. Is it necessary for a trust to bifurcate its income under different heads? The answer is no. You can actually club this, because it is not coming under section 14 where you have the bifurcation. This will be 11.1 where you take the gross receipts and this application, irrespective of the fact, because the very essence of bifurcating our revenue into different heads of income is basically because we have specific deductions for every head of income. So in case if I'm putting the salary into business income, maybe I'm enjoying better exemption, which is incorrect. But as far as the trust is concerned, this bifurcation is not necessary. It can just be treated as gross receipts, and this 85% is the only condition. And this condition of this loan, this charity definition per se, today under section 215, we have like all this poverty, education, relief of poor, all this. And all this has to be for people without any caste, creed, or discrimination. So the only exception to this is it can be for the benefit of women or backward classes, people who belong to the backward classes. These are the two exemptions where it can be for the specific classes of people where the charitable organization can happen. So specifically like when Lord McMillan, where the advancement of 4 divisions, poverty, education, religion, and beneficial, that was the changing decision which said like this English law has to be read in line with the Indian climate. So we cannot directly apply that English law to the Indian law. It has to be perfectly to match with the Indian law, and All India Spinners Association was a CIT where Lord Wright pronounced this definition of charity. Actually, like when we are talking about this charitable institution, the thing is the trust deed. When we take the trust deed or any other mother document, the parent document for that matter, there has to be a preamble, the main objects for which the trust is being formed. And there may be situations where your actual objects may not be in line with your main objects. So in the case of Gangabai Charities versus CIT, it was just said that this particular endowment is being allocated to a charity for general charitable and religious purposes. So this general charitable religious purposes is quite vague, and it was not allowed even in 1992. And today, after these amendments, we have to make sure that this particular preamble or the objectives are clearly spelled out. Nothing wrong again in including all other objectives, everything under the sky, but your main objectives, the preamble should be in line with the core main objectives which the trust is going to perform, especially when we are looking at a CSR1 form era where the company is going to examine the objectives of the trust in line with the objectives which is approved by the board, etc. But there are case laws like Tyaga Brahma, Ganasabha, and similar case laws which says like the preamble will be extrapolated and read in line with the other objectives. But today in the given world, it is better to be very, very clear in the main objectives. Now, when we are talking about an education, so there may be a trust which is started for taking care of the elderly people and the destitute people. And after that, it felt there is no need for that. And now they are spending it for education of the children. Both are valid. So both are within the definition of Section 215. But this change of objectives from taking care of the elderly people and to education is not valid, especially in a trust deed, especially when the trust deed does not have a provision to change its objects. So when we are looking at a trust deed next time, it is important that we look at the main objectives of the trust and the other objectives, and a clause in the trust deed to say that the trustees have the power to switch or change the main objects via a resolution, maybe by 2/3, maybe by 1/3 or whatever, by a resolution internally. If this is not explicit, then it might be like this Shakti Foods, where there was a case like they said all this the employees of Shakti Group will be benefited, and there were clauses which said that the deed contained like various clauses, and few clauses said this income will be applied outside India for education. So this outside India and for the employees and the spouses of employees, etc., was in violation with the Trust Act. And this assessment came in 77, 78. And believe me, the entire verdict, of course, it came in favor of them. After when they corrected, they went to the High Court to correct this because the trust deed did not have the provision that it can be corrected, it can be changed internally with the power. The trustees did not have the power via the trust deed to change the objectives of the trust. So that case, the only way out to change the objectives is through the High Court. They went through a jurisdiction change, it was not valid and all that. Of course, like end of the day, the verdict was Trust Act and the validity of change of objectives, etc., was different, and there was a specific relief act which was applicable, and that can never be a kind of impediment for the trust to enjoy the exemption. All that came later, but it struggled through for 5 long years. So any change in the trust deed is not going to be easy in the forthcoming years. Forget about 1970s and 80s. So we have to look in for the main objects. What are the true objects of the trust?
what are the activities which the trust is going to carry forward. Today, the trust might look at some objective, and maybe like down the line, 2 years down the line, maybe there is a company which is willing to fund for some CSR, and the approved charitable activity by the board, by the CSR committee, is totally different from what the trust is undertaking. Of course, they will check for the 3-year track record and all that, but still, now if the company, the trust wants to change its objective, it can happen only through the High Court in case if it does not have intricate powers with the trustees to change this. Similarly applicable for all other mother documents. So this vague documentation should be avoided, and in case like if there are allied benefits which are coming in, for example, like Bihar Wealth of Forests, where the actual objective was to protect the resources of forest. And it so happened that there were tribes who were living in that forest. About like 95% of the people were tribes, and this trust happened to actually support for the development of the tribes because they were the one who were contributing to the preservation, the main objective of the trust. So that was allowed. But all these are case laws, not sorry again for the interruption from my end. I'm not sure like what's happening. Suddenly like this interruption of the connection. In these objectives, we should make sure that the objectives are intact and it is in line with the preamble. And social objectives per se like will not be construed as charitable objectives inside and outside India pertaining to the activities, because like today the suggested mode is like the activities of the trust will be carried on inside India. So in case if the trust is formed prior to 1952, then activities outside India is allowed, provided it is for international welfare. And after 1952, the activities outside India is allowed only when it is approved by the board. And this accumulation will not be treated as income. So basically, if it is a trust which is enjoying exemption, the suggestion would be to keep the activities within India so that there is no complications pertaining to this. And whether there is a rectification of the deed, whether that is allowed. So in case there's a case law, which is like said CIT versus Delhi Stock Exchange Association Limited, 248 ITR 258, which said there was a clause in the other document which said that dividend shall be distributed to all the stakeholders, which basically is not allowed for a charitable organization. So after it got its approval, etc., after the assessment where it said that this particular clause has to be removed, the deed was rectified. Now, whether this rectification of the deed, which is happening now, whether it is valid retrospectively is the question, but there were like two case laws, the Shakti Foods, which we discussed now, and this Delhi Stock Exchange, which says this rectification, as long as, so in case if there is a clause for distribution of dividend and the charitable organization has actually distributed the dividend, then it's a different story altogether. We can't even imagine enjoying that exemption. So we would have clearly violated the act. But in case if there is a clause and we have not utilized that clause, so then rectification at a later date can also be construed as a rectification, which is with retrospective effect, and are probably like we can save our exemption so that is not under threat. Covered in the ambit of documents. So here it is like Rukmani Kannan Vidyalaya Trust with a CIT. Basically, the first question where they asked about maintaining the hostel and the applying of buses. So here the Rukmani Kannan Vidyalaya actually said that they are going to do something else, but finally like they ended up starting a kindergarten school and provide education. They also managed a ladies hostel. So this though was not part of the main objects, this happened in 2001, but today it would be like better if we have the main objects in line with what is actually happening, but all these allied activities in line with the main objects, supporting your main objects is still allowed. The case law for user Rukmani Kannan Vidyalaya Trust versus CIT. The public trust per se, like Bombay Public Trust Act, there are certain trust acts in certain parts of the state. So where the public trusts are registered under the respective laws acts, that can be taken as a precedent. So for example, like if we get registered under the Public Trust Act, that can be taken as a precedent, and that will be binding on the assessing officer to treat this as public trust. CIT versus Hazrat Pirsha-e Alam Roza Estate. So here this was for the benefit of a separate set of people. So only this people who belong to their own community, but still it was valid because it was registered under the Public Trust Act of 1950. But here again, like coming to this question of whether a trust which is purely religious or which is purely for a separate sect of people, while the act clearly says it has to be for everybody without any difference of caste, creed, color, etc. It has to be for the entire citizens of India. So this specific for benefits can be allowed in case if it is still open for others. So my objective will be to either support a wedding of maybe a specific community. There are case laws to support that as well. So that is still allowed, provided it is also open. Like in case I will support my community people, after that, if there is money left over, it is open to all. So I don't restrict and ensure that only a specific community people will be enjoying this benefit. That case it is allowed. And what if this money which is brought in is illegal? So Sri Anjaneya Medical Trust, which is CIT. So here the money was brought in was illegal, but all the compliances pertaining to the trust was intact. So given the fact of today's ATG, the KYC requirements, the restrictions in terms of cash donations, etc., there are different regulations for making sure that no illegitimate money can come into the trust. Having said that, the source of the illegitimate fund, the source of the trustee actually does not matter as long as you are compliant with the trust deed and documents. This also brings in another question which says like, what if I put in my corpus before I get my exemption? So this exemption of corpus, etc., the benefits come to me only after I get my registration under section 12AB or the relevant sections. So here, when I put in my corpus, when I start the trust itself, so when I'm registering the charitable organization, I put in my corpus. But the benefit is available only after this exemption is approved. So what happens within this time limit? The first amount which I put, academically that is not allowed, but practically that is allowed. So those corpus actually is allowed because it is for the purpose of the trust. So this any kind of deficiencies in the trust. So we haven't actually looked at the trust deed in detail so far. There may be umpty number of deficiencies in the trust deed, and this re-registration, 2021 re-registration has actually cleaned up lots of trust. So when we did the re-registration, we did go through the trust deed, whether they are in line with this objective, whether the trustees are alive, because we had to give KYCs, whether the managing trustees are done as per this act. If it is a FCRA regulated entity, whether the trustees are in line with the FCRA provisions. So all this we checked, we did the basic sanity check, and then did we file the re-registration approval. But in case, if there is any non-compliance in the trust, can further rectification be given effect to CIT versus Ganapathy Sagarmal 1990s case? So this is a case where the trustee put, they actually gave the property to the trust. So effectively, the trust was filing the returns with the income which was generated from the trust, showing in its returns, complying with all the 85-15, 75-25 those days. All this was intact. But the property was not in the trust name. When the assessment came in, the assessing officer said, unless the property is in the trust name, the income cannot be offered in the trust. So therefore, this income will be offered in the trustee's name and subject to tax. So immediately they went, they registered the document. The conveyance deed was all properly registered. This deed was extremely sorry for the interruptions. I'm not sure really what is going on. It's never been like this. So we are talking about the rectification. These amendments without permission, because whenever we apply for an exemption, we give an undertaking that any amendment change will happen only with the permission of the commissioner. In case if we do any amendments without the permission of the commissioner, this practically happened in the case of the window of re-registration. So when we were to do the re-registration, the registration process was all online, and the power was with the commissioner. So we did not really have the time to actually file a manual letter, get the approval of the commissioner, etc. So practically, we just submitted the letter and we attached this as a document so that 5 years down the line, when there is a probably a check for renewal of the trust, we have a document in place which we have actually communicated to the commissioner. So this was the practice we followed practically. But having said that, there are case laws to support that even if the permission is not obtained, that will not invalidate the exemption. The Agricultural Institute, which is Union of India, and Maharashtra, substantiated by Kamala Town, which is CIT, which is a Supreme Court judgment, where it says you can still amend the objectives, you can amend the deed despite giving an undertaking, but it has to be ratified. It has to be proper in line with the laws, or it has to be line with your objectives. And as long as you communicate this, this will still be valid. So for all practical purposes today, when we are filing this re-registration, we have to ensure that if there is any change in objective, that is being duly communicated within 1 month's time in the prescribed form. In case if it is not communicated, at least a delayed communication will help when we go in for renewal at the end of 3 year or 5 year. Because today it is all automatic, and we've seen cases where the unregistered trust deed, or when there is no trust deed or bylaws, where we just uploaded some documents, it actually got approved. So these are like technical blessings. So blessing in disguise, where we got all the approval despite the fact that we don't have correct documents. But this will not be the case when we actually go in for renewal at the end of 2.5 years or 4.5 years. That time we have to have all the documents in place. So that time we can actually take shelter behind all these case laws in favor of us, not registering the properties in the trust name, etc. All this has to be brought in properly, so that we have proper documentation in place when we are doing a officer takes a different stand, and I have disclosed this as a different stand. Then we have this Birla Institute of Technology, which comes into our rescue. So, but the underlying point here is I should not have concealed any information. I should have actually given all the information in my hand correctly to the department. My interpretation could be different, and their interpretation can be different, but the only idea is the disclosure. So if the disclosure is not there, then it's like even God cannot save us. As long as we have disclosed, then all these case laws in terms of our support can come to our rescue. What about recycling of the funds? So today I am receiving something. I am giving this as a loan for somebody to take up this foreign education. So this foreign education, they go, they study, they come back, and this they put it. I mean, this is basically the condition. I have not given this as a donation to them. I have given this as a loan. Despite the fact that this is given for interest, despite the fact that this has a profit motive, the recycling is allowed, and the case law is Kasturibai Sandhya, which is Commissioner of Income Tax. Criminal prosecution. In case if there is a criminal, we are talking about section 13, that no expenditure for any personal benefit of the people, the relative definition, the people mentioned in section 13.3 will not be allowed, and it's a clear violation. In case if there is an expenditure which is made to protect the trustee from any kind of criminal violation, is allowed as per Anandamarga Pancharaka Sangha versus CIT. So this case says, of course, this is not in compliance with the law where any personal expenditure is not allowed, but this is one exception where the image of the trustees, the goodwill of the trustees is very, very important to ensure that the trust is intact. So it is more for the operational goodwill or the essential of the trust. So this is actually allowed. And what if there is any advance? So we are talking about application of funds and expenditure of funds. If there is any advance which is being written off, so I paid some advance and I'm not able to extract that work. I'll just take 2 more minutes, then we'll take up the questions. Advance that can be written off, and it is an allowed application as per ISKCON Charities. Advertisements, the case law is Sri Nityananda Arogya Shram. So here it says like any advertisements which if the trust gives some advertisements to attract funds, that is also allowed as an expenditure unless like it falls within the conditions and it is all normal. In case if the trust conducts some entertainment activities, etc., raising sponsorship, that is also allowed, because the money which is collected is not to make profit. It is again to deploy the funds for for the objectives of the trust. So here, in this case, the substantives or probably the support which the court is giving is nobody would pay such high price like for paying in a leading newspaper to a souvenir for a trust, which is being circulated very closely. So if they are paying that higher price for a trust, for this closely circulated audience, it is only for this philanthropic intent. So this has to be allowed. And there is also a case where Sulabh International Social Service, where the main objective was school, and they also constructed toilets, and they collected 1 rupee for using the toilets. So the assessment came in that you are collecting money and you will not be allowed exemption. But then it was allowed, stating that even though they are collecting 1 rupee, their objects are in line with their objectives, and it is for general public utility, though this has to be allowed. So we'll quickly look at, and for the repayment of loan, there is one case law, Shamara Foundation. Somebody was asking that doubt, probably like you can note down. So any repayment of loan can be treated as application. And we'll quickly go through the FCRA amendments, and I will take the questions. Nothing related to the FCRA amendments. The trustees, if there are any government officials, they have to be removed. And the ceiling for administrative expenses is 20%. And when we are saying this administrative expense, in case the general parlance of administrative expense, the understanding is expense of conveyance, the rent, the maintenance of office, etc., etc. If there is a situation where your execution of objective itself warrants all this, let's say like I'm doing a research on agriculture, so I may have to travel to different parts to take the data or to help people in terms of the climate or in terms of the quality of soil or in terms of animal welfare, etc. So all my expenditures will naturally be my conveyance, etc., relating to this administrative front, which can be allowed. So this administrative should be bifurcated into pure administrative and the broader objectives, which is actually deployed for execution of objectives in terms of the FCRA. And of course, compliance with all other returns. And there is only one gateway for the monies to come into India. Of course, this will be like, everybody will be familiar with this, which is the SBI New Delhi. And after that, there is no harm. You can still have multiple bank accounts for utilizing your funds. So one pointer, one takeaway which I wanted to give is like the trust deed. So we should actually take this trust deed where we ensure that this important ingredients are present in the trust deed. The intent, like we looked at the preamble, the larger objectives, the main objectives, intent of the deed is very important. Objective should be clearly spelled. There should be a beneficiary for the trust. Though academically the settler and the trustee can be one, the beneficiary should be detailed, spelled out. And whether it is possible to have a beneficiary who is not existing, maybe my intended spouse, maybe an unborn child, all that is academically possible. Practically, I request you all to take your own stance depending on the situation. The property, whatever is there in the trust, should be there in the deed. Clear and unambiguous language is very, very critical given the kind of litigations which are going around. So this on the legal aspects to get the exemption. In case if you already have a trust deed which is like only a few months old, if you don't have these ingredients, if you have any challenges in getting this approval, suggestion would be to do a fresh deed complying with all the conditions so that you get the approval, then merge that trust with this if that trust provides so, or to start afresh. So for the exemption, it has to be open to all, no discrimination. Any amendment will be with the permission of the CIT. No activities shall be carried outside India. There is no intention to earn profit. Declaration for compliance on investment, which is nothing but the 11.5. Audit provision and declaration for usage of funds, which will be in line with the objectives. Eternity clause, which is irrevocable. Dissolution and transfer. The provision for dissolution and transfer so that your trust activities are safe. So that's all from me in terms of the charitable organizations, compliances and provisions. So I will quickly take the questions. So open 3, Ganapathy Parthiban, non-resident Indians make donation to a charitable trust which is not registered under FCRA. Yes, non-resident Indians can make. FCRA is applicable for foreign citizens of a foreign nation. Transfer of title deeds, Gautam sir, transfer of title deeds in respect of lands, properties, building, etc. from trust A to trust B. Will there be any income tax implications like capital gains? Yes, you will have to look in for the accreted provision. So in case if there is any difference between the market value and the acquired value, you have to check the provisions of section 115 before you do this. But again, it is doable and it can be safely done. Absolutely not a problem. I think we are done with the questions here.
Ma'am, the other questions maybe might have been since it is logged out and logged in, it might have gone. I will post it in.
Okay, I saw a lot of
share
questions.
the screen. Since it is logged out and logged in, it might have gone. But I didn't. 1 minute. I'll just share my screen.
You'll share the questions now.
Yeah, I'll share the screen, ma'am. Actually, I'll share the questions.
Bylaws mention that no remuneration shall be paid to the trustees members. What if they are in executive roles? You mentioned that one NGO can transfer assets to another as per the surrender of. Okay, FCRA. Yes, FCRA, it is not possible, but it's like when the trust registered under FCRA wants to shut down its activities and then transfer, it can be still done with proper permission. But this particular transfer of assets to one trust to another, the FCRA restriction talks about the donation which is received. So prior to this amendment, the donation received from a foreign country by an FCRA registered organization can be donated to another FCRA donated organization. So FCRA registered organization. So that was allowed. Today, that is also not possible. Whether you are registered, if you are registered under FCRA, any donation to you, to your trust can only come outside the, from the crossing the borders of India. So it can come only through SBI New Delhi. This is in terms of transfer of assets. There will be provisions even under FCRA in case if you want to wind up. So for the provisions under FCRA says in case if you want to wind up, if you are non-compliant, etc., then Ministry of Home Affairs will take over all your assets. But if your deed says that there is a provision to transfer this to another organization, then you can apply for special permission and do this transfer. The restriction explicitly is for the donation and not for the assets, to my mind. This bylaws mention that no remuneration. Remuneration can still be paid if they are duly qualified and if it is at arm's length. So there should not be any undue benefit to the people mentioned in section 13. But if they are actually due, like for an educational institution, if I'm a qualified lecturer, if I'm a PhD, if I'm doing some contribution to the research, remuneration can be paid in line with the others. Most NGOs represent the actual expenditure for the year in root through it by sometimes correct figure. 1 second, I'm missing these two words here. 1 second. Selma, I'll move the screen. 1 second. Most NGOs represent the actual expenditure for the year. Some routed through balance sheet. Okay. Correct. In some, I'm not getting a question, but if your question says that the actual expenditure is the amount spent being routed through income and expenditure, and the balance is moved to the corpus fund, like that is the only way of routing it through the balance sheet. So we discussed in detail that anything from the corpus is not a decision to be made now after finalizing the accounts. So in case if there is anything which is coming into the corpus, especially when you're a ATG registered organization, it has to be through the Form 10BD. You have to have all records in place. So only then you have the option of routing it directly through the balance sheet or bringing it to your income and expenditure. To answer your question precisely, any donation which is received or any rental income which is received from the assets owned or even if an agricultural income, it has to be routed through your income and expenditure. That will be your revenue, and any expenditure actually incurred, spent for that year will be on your expenditure side. And anything which is accrued, if your accounting policy, you are booking the expense which is not spent, that can still form part of your income and expenditure account, but shall not form part of the calculation for this 85%. I think I'm clear. Can a trust sell its immovable property? Yes, 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 it can. Okay, this bank FD. Bank FD is like you can you can sell an immovable property and buy an immovable property. In case if you want to take time on getting this immovable property, then you should actually invest this within 6 months in the prescribed modes under section 11.5. Of course, bank FD is a prescribed mode. In case of a trust created specifically to carry out CSR activities of group companies and accounting on cash basis, can the amount unspent be shown in the balance sheet and not passed through IE? So if it is cash basis, then where is the question of amount unspent being shown? I am not clear. But if you're using cash basis, then it is clear. Whatever money received and spent, it can be there. And whatever money you have not spent, if that is your question, out of this, the accumulated point, if you're talking about, then you have to file the relevant form within the prescribed time, the form 10. That you can, you have actually taken this money for CSR activities and your project expands for a period of 3 years. First year, you are supposed to spend only 30% as per the project plan, and that is what you have spent. The next tranche will be as per the project plan. So that you can give as part of your resolution in form 10 and get this accumulated. That has a problem. White form 10 got a provisional order. After that, we to get a permanent order, we are okay, which was got rejected because we have not once again furnished reply for their queries within the stipulated time. And file that return for trust. Yes, you can actually after the due date. As I told you, like this is definitely a violation of the provision, but better late than never. So today, since the law is not settled, the department can take a liberal view. But at the end of the 5th year, maybe like you are doing some, there are some lapses this year, you are able to regularize it for the next 4 years, then you are good to go. At least you have something to substantiate stating that this lapse was not intentional, it was due to technical glitch, and we missed sending the reply basically because the email was not seen or any other reason. So it's good practice to file it now. Yeah, husband and wife can be the trustor and trustee. Absolutely not a problem, but that will be a private trust unless like the objectives are as per section 215. The beneficiary should be like for all. I mean, 215 should be satisfied and all the conditions for charity should be satisfied to get exemption under ATG. 12AB can be not a problem. If the institution restaurant is having commercial complex and it's let out, some part of the building is also let out, similar institute of same management. Okay. Any properties, any income from property owned by the trust will also be treated as income, the normal donation route, and you have to apply 85% of it. In case if there is a similar institute of the same management, then it becomes a related party transaction. If it's a related party transaction, you have to make sure that the rentals are the same. There should not be any transactions which is above or below the arm's length. So that is what you have to check. If it is at arm's length price, like a part of the commercial complex is now let out, you already have a market price in hand. So if it is like 17 rupees per square feet for the others, if it is 17 rupees for the institute of the same management, it can be let out. Income has to be shown here, application has to be shown here. And in case if they are consolidating, if it's a 1023C organization and there are like different institutes under the same management, it will get consolidated in the umbrella. Newly registered trust carrying on primary school coaching class for entrance exam like NEET and a play school yet to be registered. Okay. Okay. So I would suggest 12AB, but in case like if you're looking at expanding your business as a business, or today education is business only. So if you are looking at expands, then 1023C would be better. So this requires more information to give you an answer whether which is better, which is more about whether income from coaching classes and play school be considered as education purpose. Okay, so here again, like when we are talking about collecting fees for education. So there are case laws which says like in case if you are collecting more fees, which is not in par with the normal prescribed fees, etc., like what private schools do these days, then you have an intent to do earn profit. So in case if your fees in line with the market trend, etc., your fees can be considered as the normal income applied for the objectives, and your accumulation, etc., can be the normal route. It need not be treated as business. Whether donation received held by the trust in savings bank account. Yes. 11.5 today interpretation and my humble opinion, this is a prescribed mode under section 11.5. Any other questions, Selva?
Those were the questions. 1 minute. Let me just check.
So I think we are done. Are there another 11
Yeah.
more questions?
We have done actually only one
All
question.
this what-
Only one question. We'll take it up and we'll wind up because we have gone past time. Actually, I just
Yeah, sure.
get the same question. I think it's later.
Yeah,
too.
same question. Yeah.
The last one, the trust 12AB.
Well, so yeah, you can actually file an amendment deed and get it approved. So any correction, any lapses, either through a grievance or through reapproval can be done. There is no restriction that once it is rejected, you should not reapply. Like the pre-amendment era, we can apply any number of times. So you can do that and regularize your trust exemption. So I think we are done with the questions. I thank you for the wonderful opportunity and thoroughly enjoyed interacting with all of you with a lot of questions, a lot of learning indeed. Thank you very much, SIRC, for the wonderful opportunity,
Yes.
and big thanks to the wonderful audience.
Yes, sir.
Over to
Thank
you,
you. Thank you so much for the time spent here, ma'am. On behalf of chairman, secretary, and office bearers in the absence here, we thank you so much for the time spent here, and we look forward to having you in future for many more sessions. Yes, as always. Thank you, ma'am. I'll wind up the session. Thank you.
Yeah, thank you. Thank you all.